Welcome back. I'm a 21-year-old investor looking to compound my wealth in the stock market. And in today's episode, we'll be covering three main portions. The first portion will be, of course, on Netflix shares. The second portion will be on Oracle stock. And the last portion will be on some quality stocks that I view as attractive in today's market. So Netflix shares is up around 2% today. Over the past 5 days, it's down around 4%. Over the past 1 month, it's down around 16%. And from its all-time highs, the stock is down around 30%, 28%. So I actually covered Netflix in a previous episode already, so I'll go slightly more in depth in this video. And we'll be referring to this Substack here, which is a newsletter that we post weekly. So feel free to check it out if you're interested. It is the top link in the description below. So as covered in a previous video, Netflix has two main modes for the business. First of all is their scale as well as their network effects. So the ability to distribute the content that they already have. And the second one is the content IP that the company has and has the ability to leverage on. So the key difference between Netflix as well as its competitors, like for example, Disney, Amazon, Paramount is this. First of all, Disney is leveraging on their existing content IP. So you'll see a lot of different shows whereby Marvel characters, they go on to do even more things. They extend libraries in that department. So Netflix, they don't really do that. They do that for successful shows only. For Amazon, what they do is they tap on their ecosystem to try and bring in subscribers. So most of the Amazon Prime subscribers, they don't really want to subscribe. They're just subscribing to it because it is already given to them for free, along with the Amazon Prime subscription. So for Netflix, they are the only company that is solely focused on content, so they're not distracted by the other portions of the business. And second of all, Netflix is a company that creates new content. So they're not actively leveraging on their content IP that they're already using. So they're not fully focused on creating new series out of what they already have. They're trying to actively create new ones. So for Netflix, it is a company that will not result in its consumers having something called content fatigue. So content fatigue is when you see the same shows over and over again, just packaged in a different way. That is what Disney's content could lead to. But in the case of Netflix, they're less prone to this. So that's the key difference between the streaming platforms. And of course, Netflix is a clear winner in the space. So the downward price action for Netflix is after their earnings, when they missed their earnings report. And then besides that, what actually worsened the downfall was this acquisition attempt of Warner Brothers Discovery. So let me try and summarize it for you. This is my view and my take on the situation. First of all, I view the Warner Brothers Discovery acquisition as a positive one for the company with increased cross-selling and bundles between the two platforms and a wider content library for future monetization. With most consumers already accustomed to subscribing for more than one streaming platform, the bundling offer by Netflix and Warner Brothers Discovery will be a greater value proposition for consumers. So it will bring in more consumers overall. And besides that, Netflix is a company that is solely focused on content. It is the only company in the S&P 500 that requires content to keep the business alive. So I'm sure they know more than most investors do in terms of how valuable this content IP is to them. And it can be seen as sort of like an investment into content, similar to what they do yearly in terms of the acquisition of content IP. So Paramount actually bid for Warner Brothers as well. They bid around $30 a share. The key difference between the two bids is Netflix is bidding $27.75 per share for Warner Brothers, excluding the cable TV portion. Paramount wants the cable TV portion as well. But if you actually look into the numbers, what Paramount is doing is they're valuing it at $2.25 per share. The cable TV portion is a $20 billion revenue run rate business. So if you include a 0.8 times price to sales, which is what Comcast is trading at today, that means that that portion is around $16 billion of value. So what that means is that that portion is $16 billion worth, which works out to around $5 per share. So if you do it based on sum of the parts, then Netflix offer is better in this case, which is why I think Paramount could bid a lot higher than what they're bidding today. It will bring Netflix into a bidding war, which is why the stock is trading down. So coming back to this, I think there are two clear theses for Netflix shareholders today. I've highlighted this in the newsletter. So first of all is the company's ability to leverage on their existing content library. So besides their traditional streaming services, there are streams of revenue that the company can leverage on with its existing content IP, similar to what Disney has done with their IP. So they recently just opened a new theme park. I believe they did it today. And shops as well as franchises, licensing deals. With traditional cable TV, the optionality is endless for Netflix. So the ability for the company to leverage on this content assets will drive margin expansion over time. All the spend is upfront with the shows that they create. So every subsequent dollar that they collect outside of their streaming arm is basically pure profit for the company. And this brings me to another point for the company's income statement. This was what I highlighted in the previous episode. So the company has a line item, which is this thing over here, amortization of content assets. And what they do is they assign a 4-year time period for this content assets. So in my opinion, this is the management understating the company's earnings ability with this content assets, and any adjustments to the lifetime will significantly boost the company's earnings. So a lot of these content assets are investments that generate income well beyond the 4-year period. I'm sure people are still watching Stranger Things, previously Prison Break when it was still on the platform. And with the rise of TikTok videos related to Netflix films, the lifetime of these assets should be a lot higher. So some legacy films will be treated as investments and not mere expenses. Adjusting for this amortization expenses, the earnings ability for Netflix is a lot higher. A better metric is EV to EBITDA or EV to sales. So the next thesis for Netflix, of course, is the ad growth for the company. So the company is trying to push the ad portion where they offer a lower price to include ads for the consumers as well. So the ad option is $7.99. The non-ad option is around $17.99. So what this implies is that the expected revenue from this ad is supposed to be around $10 per month. So I reverse engineer some of the numbers, and what I worked out was that the CPM right now, the expected CPM is actually around $13 based on the difference between the ad tier as well as the non-ad tier. But for Netflix, they actually have a lot higher of a CPM, and the Warner Brothers Discovery acquisition will further increase this CPM because it will attract even more advertisers into its advertising space, and the CPM based on recent numbers is closer to around $20 to $30. So what that means is that as Netflix push its ad division even more, it stands to gain even more profits over time because the CPM number is actually higher than the expected CPM number. So besides them being able to pull in more customers that are more price sensitive, what this also means is that they stand to gain more economic profit because the CPM is a lot higher than what the expected value is. So the company's ad option has been a great move, with management acknowledging that the ad revenue has doubled from 2024. So launching ads, a high margin revenue segment, allows Netflix to bring in more price sensitive customers that may not have subscribed, broadening their potential total addressable market while also capturing better economics. So this is a great move by the management. So this one over here, this is a chart on Fiscal AI. It's also another link in the description. Feel free to check it out. I think I saw a few comments asking me what software I'm using. So Netflix, is it attractive today? Based on the median multiple, this is the EV to EBITDA. This is the price to sales or the EV to sales. So EV to sales is still slightly higher than the median over the past 5 years. EV to EBITDA is below the median over the past 5 years. So Netflix shares is currently still trading at a premium. But of course, it is a quality business, so it isn't a problem to add currently. I'm actually looking to enter into Netflix shares closer to around $80 to $90 a share, so hopefully it drops there. Noise and regulation headwinds will keep coming in, so I expect the price action to trend further downwards. Next portion, I'll be covering Oracle's earnings. So as you can see over here, Oracle share tanked 15%, dragging down Nvidia, AMD core weeps. So Oracle's earnings weren't bad. I think their EPS was a bit, and the revenue was a slight miss. So its revenue came in at $16.06 billion compared to $16.21 billion expected by analysts, and then it dragged down other AI names as well. So the reason why Oracle is down is because the company is raising more debt. So Oracle has been a subject of much market chatter since raising $18 billion in a jumbo bond sale in September, marking one of the largest debt issuance for the tech industry on record. So the name shot onto investors' agenda when it inked a $300 billion deal with OpenAI in the same month. Oracle made further moves into cloud infrastructure where it battles big tech names such as Amazon, Microsoft, and Google for AI contracts. So I think this is healthy for the markets. What the markets are signaling is that the markets don't want excessive leverage. And this Oracle drop in terms of stock price substantiates that point. So investors have questioned Oracle's aggressive AI infrastructure build-up plans and whether it needs such a colossal amount of debt to execute, though other tech firms have also recently issued corporate bonds. If you compare the debt to EBITDA for all those different companies, compared to Oracle, Oracle's debt is just incredibly high. Overall, I think it is a positive that the markets are selling this off. It is healthy. And what this means is that companies will not actively push for financial leverage to try and gain more share in this AI space, like what Oracle is doing here. Last portion, I'll be covering some stocks that I view as attractive today. So first one is MasterCard. This stock is up around 3% today. And I actually made it one of my larger positions in my entire portfolio. This is on my main account, my IBKR account. And for MasterCard, I think the company is still trading at a decent valuation, even after today's jump in terms of stock price. So for MasterCard, I know there are some headwinds that people are saying, like for example, your A2A transfer, which is account-to-account transfer, which is sort of like a direct transfer method, like for example, your PayNow, your local rails as well. That's another possible headwind for a company like MasterCard. But the counter argument to that would be that all these different platforms, all these different services have existed for quite a number of years already. And MasterCard has been resilient through this time. So for MasterCard, you have other clear tailwinds next year also. You have sporting events next year, which will increase cross-border transactions, which is a portion that MasterCard is heavily reliant on as well. So I think for MasterCard today, the company at a 35 times price to earnings. On a historical basis, it is relatively low. So this is a company that I still view as attractive today. Next stock is Amazon. So Amazon today is down around 0.6%, and year to date, this stock is lagging behind the S&P 500. So it's up only around 4%. The stock is currently trading at a 32 times price to earnings. And on a price to operating cash flow basis, by the way, this is fiscal AI again. So the stock is at around 18 times price to operating cash flow. The median over the past 5 years is at around a 23 times. So of course, Amazon is slower growing than what it was back in the previous years. But Amazon today is arguably a better business than what it has historically been. You have AWS that is thriving. You have your subscription business that is doing very well. You have your advertising portion that is still growing extremely strongly. So Amazon today, I view the company as decently priced amongst the Mag 7 companies. And that is why I think this is one of the companies to look at, besides Meta, of course. I hope you guys have found this video useful. Feel free to check out the Substack and invest safe.